Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. Markets yesterday taking a bit of a pause. What does today hold? That's the question. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, Prashant. Good morning. Good morning, Nigel.
Morning.
It's kind of that time of the year when things have quietened down in the market. You know, flows have thinned out. Nothing much happening. People perhaps all getting ready for Christmas, for New Year. So it's a festive cheer all over.
Absolutely. So, yeah, just counting down few days to go and then Christmas. So, but we haven't tracked the markets. But on a personal note, I'm very excited and happy as well.
How many hours now, the clock is coming up?
I mean,
300 minus what? 24?
No, I'll be around for less than 100 hours here at the studio. And then I'm coming back on January 1st. But good times.
But there's also so much festive cheer outside, right? I mean, if you look at, especially in places like Bandra, there's so much,
Beautiful.
It's lit up for Christmas and it's fun.
You know, normally me and my wife go for a walk after dinner. But yesterday we said, let's prepone dinner, let's finish it early so that's why we can walk around and see
all the lights.
Lights. There's beautiful decorations.
Christmas
but
carols,
good times, but we got a market to contend with today.
Absolutely. You know, so let's just kick it off because the market has been looking good as well, right? Absolutely no two ways about it. Yesterday was a bit of a pause, and I think that's where we're going to begin, where we left off yesterday. So the Nifty ending slightly lower, about 0.25% down. The Bank Nifty actually was the bigger culprit, down about 0.5% plus. We saw a pause yesterday. It's been a massive two-week rally. Absolutely, stellar. Now, overnight, global cues are actually positive. There's no problem, really. So S&P is up 0.5%. The Nasdaq is up about 0.6% or so. Yields also moved up, but nothing major, right? When we're still under 4%, 3.94. The dollar index is at about 102.5. So no real problems. Now, this is the thing. You heard the big global kind of cue or the shift, or the regime shift you want to talk about is the Fed pivot. That happened last Wednesday when that one statement was the Fed Chair Powell saying that rate cuts are coming into view. That got people excited like what? Absolutely, markets have gone, there's a 180-degree sentiment turn in the US as well. India has been doing well irrespective of Fed hike, Fed cut. We've been kind of on the way up. But globally, sentiment has changed on that comment on Wednesday. But it looks like, after Wednesday, every day there is a Fed official who's coming up and kind of cool markets down, saying, as they say in Hindi, zyada bol diya. Now you got to kind of walk back, pedal back some of the commentary. Not necessarily that markets are listening, but this is what has happened since Wednesday. You basically had on Friday, Fed's William, who basically the New York Fed president, who came out and said that cuts are not the topic of discussion. This happened actually in a broadcast sit-down TV interview. And last night, you had another Fed governor, Mester, who came out and said that financial markets have jumped, and I quote, a little bit too ahead. Now, these are all aimed at cooling sort of, animal spirits down, markets down a little bit and saying, well, don't price too many cuts in too early. And of course, they don't want markets to go wild, right? Because, markets rallying are the opposite of sort of financial conditions tightening. It's financial conditions loosening. The whole point why they're thinking of cutting, and they're talking about cutting, is that things are getting too tight. So they don't want financial markets and everything else to be ahead of what they want to do, and they want to kind of sort of direct this as ably as possible. Markets, though, did not listen. I mean, I read out the changes in US markets overnight. And of course, this happened right in the morning before the US market started. This comment came in. Markets rallied on nevertheless. But will this become a factor as we go into the end of the year? This is something we need to watch out for, given how strongly global markets are behaving now. Now, oil was up about 2% or so. We're at about $78. There is that problem in the Suez Canal, and we'll talk more about that later. That's a big route for sort of container traffic, global container traffic, but also for oil containers and other stuff. And we can talk more about that. But again, oil needs to be on a bit of a watch. Just to circle back to levels here on the Nifty, we need to clear 21,750 on the upside. This is the level we put out earlier as well. And the range to get clear past is now 21,750 to 21,900 on the way up. Supports for the Nifty come in at 21,177, which is the new 40-day exponential moving average. I mean, the thing is, either on the Nifty or the Bank Nifty, even though we corrected, the hourly sort of averages did not break. So the support for the Nifty is right here at 21,177. The Nifty Bank, it ended lower but did not break the hourly averages, as I said. And support here comes in at 47,537, which is the corresponding 40-hour exponential moving average. So trail these levels. I mean, essentially, that's the whole idea. Yesterday, the market started lower and then it completely recovered. We were in the green and then there was a bit of a sell-off which came through as well. Perfectly natural given the fact that we came out of 2 weeks of 6% gains on the Nifty and the Bank Nifty, which had rallied almost about 8% or so. These are massive. I mean, you know, these are in some not bad years, okay-ish years, yearly gains. You've basically sort of done this in a fortnight or so. The mood is very positive, but as I've been saying, there's no need to chase things down. I mean, you get dips. You buy what you want to buy, especially, I mean, if you're not trading the index, it's much easier because there is enough happening under the index as far as stocks are concerned. So that's what you want to do. Not chase things higher, wait for dips. It's a market which will give you opportunities. The GIFT Nifty indicating an absolutely flattish kind of start. Sonia.
Oh, absolutely. And, you know, this is that time of the year, as we said earlier, where the lull now begins. The flows thin out. People are perhaps going to take big positions at the start of the new year. People start going on leave as well. So maybe you could see the markets consolidate for a bit. Remember, we had a big surge last week, so the market is in sort of consolidation mode. The US market cues are also very, very quiet. And this morning, the GIFT Nifty is also suggesting that we'll have a really quiet start, which is not a bad thing. Flows have also thinned out. DI has bought about 400 crores, but there was hardly anything from FIs. FIs sold about 30 crores or so. Don't lose sight of what's happening in the commodities market because gold and silver are the big focus areas now. A lot of people are talking about silver ETFs and how that's picked up in terms of, you know, an investment option. Gold prices have gained globally. In fact, spot gold prices are now at $2,000 per ounce, $2,000 plus. Per ounce. So keep an eye out on that. The US Treasury yield continues to be low, so at the lowest level since July. But the big theme for me is rate cuts, really. That's going to be the big theme of 2024 as well. Traders are now pricing in almost a 70% chance of a Fed rate cut in the March policy itself, as per the CME Fed Watch tool. And for our own markets, that's going to be the big trend to watch out for. Real estate, NBFCs, autos, all the segments that have an exposure to rate sensitive. So real estate stocks, by the way, are still below their lifetime highs. There was minor profit booking that you saw yesterday, but even if you look at stocks like DLF, right? DLF is still 70% away from its lifetime high of 1,225 that it hit in 2008. So if you expect that, oh, the rally is too much and maybe it may not continue, don't lose sight of the larger picture, which is some of these stocks are still well away from their lifetime highs. So keep an eye out on that. There are many, it's IPO season. There's an interesting IPO opening today, Happy Forgings. So let's see if investors are happy with that. But for now, looks like it's just going to be a day of consolidation.
Well, you know, so I'm going to use an analogy, right? When you're getting into a holiday season, you're going, meeting relatives, partying, enjoying, taking the kids out, and then a couple of days of just rest is good, right?
Yes.
So even for the Nifty, I think the way we have run up, some kind of consolidation would not hurt. And maybe, in fact, it's warranted as well. The uptrend, keep in mind, is very much intact. But some kind of consolidation will be par for the course. The Nifty Bank, though, moving to that 50,000 mark, that's the key trigger, you know, from the bullish perspective. How close can it get to around 50,000? And that's going to be, the big driver for the Nifty as well. Very, very high interest, though, in the mid-cap space. And still, there are plenty of winners out there. Well, there are signs that maybe some stocks have run ahead of themselves. So you need to be a little bit wary out there. Hold on to the good quality names. Well, the Nifty Financial Services Index as well will be playing out expiry today. So we'll be keeping an eye out on that one. In terms of the Nifty, well, on the premium on the Nifty came down to around sub 60 points from around that 100 points. Also, you're wondering whether or not there was some shorting. No, there wasn't any shorting. Actually, there was unwinding, both on the Nifty as well as on the Nifty Bank. There was open interest that was cut by around 6 to around 8%. Also, there was unwinding of positions. On the options side, after a while, we saw more call writing in comparison to put writing. 21,500 call, that was fairly active. The FI positioning, by the way, is still, it's still towards the long side, around 51,000 contracts on the long side. Now, you move to the options data then. The 21,500 call, well, that was very, very active in trade. 21,450 call, well, very active in trade. Between both of them, it added close to around 85 lakh shares. So there was writing being seen out there. The premium on both of them came down to half. The premium at the start of trade on the 21,500 call was close to around 120 rupees. So it ended at around 65 rupees. But on the downside, the 21,400 put, well, that as well is fairly active. So just plugging in those numbers going by the options data. On the upside, the 21,620 mark, that will be a resistance zone from a bullish perspective. And because of the kind of call writing we have seen, Now you have the PCR that's come down from around that 1.5, which is the upper end of the band, to around 1.1 odd. Moving to the levels, the resistance, 21,620 approximately, that becomes a crucial resistance zone from a bullish perspective. On the downside, since the 21,400 put, well, that was fairly active premium at around 100 rupees. You're looking at the 21,300 odd band. So that's a very, very tight band that we're talking about. On the Nifty Financial Services Index, I went through the options data, and those contracts expire today. So on the Nifty Financial Services Index, the 21,600 and the 21,380 level is extremely important. GIFT Nifty suggesting, I think, a more or less flattish chart the last time I checked. As flat as can be. So let's see where we go from here.
All right, let's see where we go from here. But for now, it looks like it's going to be a quiet one. We have a lot of commentary coming in for you this morning, so let's get straight to that. Mahesh Nandurkar says the Jefferies Economic Indicator for October 2023 was down 2.9 percentage points over month-on-month to a 22-month low of 4.6%. Adjusting for the festive season shift in Diwali holidays, October-November 2023 average growth as per the Jefferies Economic Indicator was 6% year-on-year, which is in line with the 2023 performance. Mahesh adds strong two-wheeler demand raises hopes of elusive rural recovery, though other data points are not very supportive. The rise in CPI inflation is likely to be temporary in view of benign global rates outlook and softer crude prices.
All right, Rhythm Desai of Morgan Stanley weighs in, saying that India is now a $4 trillion market with indices across the board ending the year at lifetime highs. He says Indian equities continue to outperform emerging markets, adding domestic institutions hold the bid while FPIs reverse their 2022 selling. Volatility made new lows amid strong macro and micro fundamentals.
Okay, let's get you a handle on what's happening in the rupee market as well. The money markets, Abhishek Goenka of IFA Global says the trade deficit normalized to the earlier run rate of $21 billion a month. FPI flows, especially into equities, have accelerated after the Fed's surprisingly dovish pivot. He says the RBI, which had kept the rupee under a tight leash, allowed some adjustment in the rupee as well. He expects the dollar INR to trade in a range of 82.70 to 83.50 over the medium term, with a slight appreciation bias.
On bonds, this is Vishal Goenka, co-founder of IndiaBonds.com, who says that after having rallied 10 to 15 basis points last week post the US Fed meet outcome, markets took a breather. Government bonds moved in a tight range, and they were mostly unchanged yesterday. He says with the holiday season and lack of significant economic data, bonds should remain mostly unchanged and trade with a 2 to 3 basis point range, with an eye on Bank of Japan policy later this morning as far as that global sentiment is concerned.
Well, we've got a lot of stock-specific action to track for you. We get to that in just a bit. But for the time being, we list down the stocks for you. We're looking at Vedanta, Devyani International, All Cargo Logistics, Keynes Tech. We have PNC Infra, JTL Industries, and India Glycols. All of them will be reacting to positive news flow. While on the flip side, Apollo Tyres, KPI Green, and OMCs will be reacting to negative news flow.
All right. That's the list of stocks. It's a lot. I mean, and we'll get to that very quickly. Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thank you very much. You know, the Fed Chair Powell said rate cuts are coming into view. And since then, we've had official after official, three of them saying, well, cool it, not so fast. What's going on? I mean, did they underestimate the ferocity of the market reaction? What should we go with what they're saying now or what the Fed Chair said then?
Good morning. Thanks for having me. I think the market's pricing in, as you're aware, that about 6 rate cuts in calendar year 2024, whereas Fed dot plot shows, I think, 3. So I think there is again a gap between what Fed is seeing the rate cut trajectory versus the markets. So I would think that the Fed governors in the subsequent week, they're trying to bridge the gap. But I want to make a more important point here, that whether the cut is 75 bips, 100 bips, or 150 bips, that only time will tell. But the most important statement coming out of the last meeting was that the risks are now balanced, which means if the economy were to slow meaningfully, Fed will be there to cut rates. The risk for emerging markets were always going to over-tightening and a hard landing in US. But with this balanced word coming back in the Fed speak, and the Fed being ready to cut rates, I think substantially increases a soft landing scenario, which is a positive for emerging markets, including India.
Okay, Rana, hi, good morning. Always great speaking to you. And this is, the end of what has been a fabulous year for equity markets, right? The Nifty by the end of the year is up almost 20%, and the mid-cap index is up almost 45%. We haven't seen a year this good in a while. Do you think India can replicate these kind of returns in 2024?
So I think even if you look at this year numbers, right, like you rightly said that markets are 20%, but mid-cap 45. If you go to the sectoral indexes, real estate, I think you were just mentioning 60%, capital goods 60%. So I think the broader point is that market remains were reasonable. I think 20% reasonable return, one should really settle for that. It can be a 15 or 12% also going into the next years. But the real action will continue to lie in different sectors and different stocks. Just like, if I take a step back, previously people used to think about emerging market as one entity and they used to allocate capital. I think that's slowly changing. They're looking at India and other markets individually. Within India, I think we have to also look at sectors differently. We cannot, we can take a call on the market, 10, 12, 15% upside or something like that. But I think more importantly, we need to take a call on sectors and the stocks. For that matter, I think we have been and continue to be more bullish on the domestic related sectors than the international exposed ones.
Okay, all right. Hi, Rana. Well, 2023 clearly has belonged to India in comparison to China. But India is trading, at elevated multiples and maybe with good reason. But current reckoning, do you think that, there could be some kind of a play that moves to China maybe in the next 6 to around 8 months? The longer term, yes, India is looking much better. But at these multiples with the kind of very, very weak economic data coming out of China, something's got to give. Your take?
So I think first of all, I think going to next year, we have a constructive view on the FI flows because it's likely that US will cut rates, but I don't think the strength in emerging markets, necessarily the central bankers in emerging markets will follow to this full extent, which means a lot of flow could come here. So even with the flow coming here, China could get some share, but I don't think China is going to get the share that it used to get, which means emerging market ex-China, the flow, the pie, the FI flow pie is going to get somewhat bigger than in the past. Coming to China specifically, I think the economy is slowing and their government of late, the authorities of late are doing quite a bit in terms of fiscal, even they have loosened the fiscal string also a bit. But the problem with the longer term problem with, I think, China now is about their demography and the declining, the age profile. So the point is the real estate and the exports, which had really driven the economy over a long period of time, both are in some sort of challenging situation right now. Export we have discussed why, and real estate because of oversupply. Until these two problems are specifically resolved, I think all this kind of stimulus will only give the market or the economy some temporary recovery. And to that extent, I think emerging market ex-China, particularly the market which has large hinterland like India, will continue to be one of the favorites for the investors.
All right, we'll let you go on that note. Thanks a lot for joining in and giving us your quick take. Happy New Year to you and your entire team, Rana. Hope to see you again very soon. All right, that's a call coming in on the market. Let's take a quick break. Plenty of stocks in focus on the other side of the break. Our entire research team will be with us.
CNBC-TV18, embarking on a quarter century of excellence. A century of excellence.
All right, it's holiday season. Markets are clearly in Christmas mood, so very, very quiet. The Gift Nifty is also indicating that, but there are plenty of stocks to talk about. So let's get straight to it. Sudarshan is joining in first up to tell us about Apollo Tyres and why he's watching that one. Sudarshan, good morning.
Yes, another block deal is on the cards. Apollo Tyres is likely to see a change of hands for 3% equity via block deals today. White Iris Investment, a Warburg Pincus affiliate, has announced this block having size of $100 million and for which the floor price is ₹440 per share, which indicates a 2% discount to yesterday's closing price. The term sheet also indicates an upsize option and that depends on the demand. Post this share sale, there will be a 90-day lock-in period if White Iris Investment plans to sell further stake. As of September 2023, The holding of White Iris investment in Apollo Tyres was at 8.04%. Now, talking about the stock returns, in 2023 so far, Apollo Tyres has been up 40%, and that returns have been in line with other tyre companies. In December 2020, White Iris had converted compulsory convertible preference shares into shares at ₹100 each.
All right, the long-awaited block finally takes place later today. Thanks a lot for that, Sudarshan. Well, I'm looking at Vedanta. We're waiting by for the dividend. The dividend has come in at around 11 rupees, and that's better than, the Phillip Capital analyst who had joined us a couple of days back. He was expecting around 7 to around 8 rupees. So in that sense, it's better than expected. The total payout from this particular dividend will be close to around 4,089 crore rupees, out of which the promoter entity will get close to around 2,605. The record date will be December 27th. And in fact, if you look at this fiscal so far, they've declared dividend of around 29 rupees 50 paise. But since they're going to be getting the promoter entity, that's Vedanta Resources, will get this money, and they will be able to service part of their debt, because 2,600 crores, well, that amounts to roughly around $320 million. They had to, service that debt of around $1.2 billion odd. So they've managed to do part of that, which is pretty good news. I expect the stock to open up in the green, though it's seen a big run in the last few days as well. Well, let's go across to Mangalam to tell us about Devyani as well as All Cargo. Mangalam.
Well, for Devyani, they've gone shopping, and this time around they've forayed into the Thailand QSR space by acquiring Restaurant Development Company. This enables them to buy, 274 KFC restaurants in Thailand to a partnership in which Devyani will hold 51% and the remaining will be held by Temasek itself. The total deal value is close to around 1,070 odd crores, of which 340 crores will be given by Devyani. Temasek will give around 330 odd crores. Local debt will be around 380 crores, for which Devyani will be giving a corporate guarantee. What this does to their overall line-by-line consolidated revenue, 35 to 40% increase out there. But if, one takes account of the minority interest, then the overall addition to their revenue will be 14 to 19%. While it is a value accretive deal and I expect the stock to be in the green, a lot of the brokers are worried about the company, looking outside of India for growth opportunities itself, and whether this will, lead to a spate of acquisitions abroad or not. So that is something we have to watch out for. For All Cargo, acquisitions are galore. They've bought about 51% stake in ECU Line Middle East for about 14 odd crores. They've also bought 14% stake in Eurocenter FZCO for about 14 odd crores as well. This will increase their overall operations. And their other arm, which is All Cargo Gati, the board will meet on 21st December to consider a fundraise. So all those stocks will be on our radar.
All right, thanks a lot, Mangalam, for that. Let's hop across to Abhishek now. He's tracking Kaynes Technologies. Let's find out why. Abhishek, over to you.
Well, Sonia, sources tell CNBC-TV18 that Kaynes has launched a QIP. The amount is about 1,400 crores. The issue price is about 2,424 per share. Now, remember that this is at a discount of 1.1% to SEBI floor price and around 6.9% discount to closing price on BSE that you had yesterday. Dilution is about 9.9% stake over here. The lockup for promoters is about 90 days, and BRLM, or book running lead managers to the issue, is Access Capital, DAM Capital, IFL Securities as well as Nomura. In another announcement that Kaynes has done, they will acquire Digicom Electronics Incorporation. The consideration which will be paid is US $2.5 million for that. Back to you.
Okay, Abhishek, thanks very much for that. More stocks in focus, KPI Green and PNC Infrastructure. Vivek has got details. Vivek, hi, morning.
Well, good morning. That's right. One more fundraise, KPI Green Energy. Companies looking to raise funds via the QIP route, looking to raise up to 300 crore, 150 crore base size, another 150 crore of an upsize option. The dilution is close to 6.74% of the pre-issue outstanding share capital if you take into account the upsize option. QIP indicative price is at 1,183 rupees a share. Why is the company raising funds? This is number one, to part finance capex as far as one particular solar power project in Gujarat is concerned, and the other is for general corporate purposes. The second stock that we are talking about today is PNC Infra. The company has emerged as the lowest bidder. This is for a hybrid annuity model project. This is in Madhya Pradesh Road Development Corporation. The project bid cost that the company had the lowest bid for is close to 1,174 crore. Positive news as far as PNC is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, I'm looking at JTL Industries, and if you look at it in the last 3 months, the stock was around 250 rupees. Then it corrected all the way to around 200 rupees, and there was a large trade that took place out there, with the promoter entity went ahead and bought close to around 1%. This was just 2 weeks or so ago. So Now it's back close to around that 52-week high, just a few percentage points shy of that. The big news coming in last evening was that there was a board meeting and they have approved issue of securities via the preferential route, and they're issuing 3 crore shares. Out of the 3 crore shares, 2 crore shares will be issued to the promoter entity, 1 crore will be to the non-promoter entity. What stands out is the price that they're going to be doing this preferential at, 270 rupees per share, which is more than a 10% premium in comparison to yesterday's close price. Now, the total amount that they'll raise via this preferential issue will be 810 crores, which means that the dilution will be around 15%. They've also approved a QIP amounting to around 500 crore rupees, and this money will be used to expand capacity. They're looking to expand capacity in Maharashtra, and they have announced a big mega project of around 1,200 crores. Or expect the stock to open up in the green. Remember, it's a smaller peer in comparison to APL Apollo Tubes, but it trades at a sharp discount out there. So let's see whether or not the street is willing to re-rate this one, but it should open up well in the green. Going back to Sonal, she's here to tell us about India Glycols. Sonal?
Good morning, Nigel. Where the company is in focus because they have been allocated quantities to supply ethanol to different companies, and this will be grain-based ethanol. Contracts are coming in from HPCL, BPCL, IOCL. There's Reliance Industries and Nayara Energy as well. So it is a total contract amounting to 1164 crore rupees. The OMCs have given a contract of 896 crore rupees, and all companies have given a contract of around 268 crore rupees. And this is for the ethanol period of 1st November 2023 till 31st October 2024. Important because there have been some on and off with sugarcane based ethanol. So grain based is something which is gaining a lot of traction, and this is what we are seeing with India Glycols today.
Okay, thanks a lot for that. Let's also find out what's happening in the world of crude and how you should be approaching it this morning. Manisha is here to give us the latest. Manisha, over to you.
Well, thank you for that. We're looking at a 3% of a jump in crude prices in the overnight market. This is in reaction to the U.S. announcing 10-nation Red Sea coalition against the Houthi attacks on commercial tankers. Now, we have a lot of oil companies and tanker companies which have paused travel through the Red Sea. Let me remind you that 15% of the world shipping traffic transits via Suez Canal. So either we're looking at a pause or many of these are going to go via Cape of Good Hope, which is a longer route. So that is what has led to premium building up in case of the crude oil prices. In addition to that, it also is Russia announcing 50,000 barrels per day of additional export cuts for the month of December. There is price increase as well coming in for the Asian market, and all that seems to be supporting prices at this point.
Okay, all right. Thanks a lot for that, Manisha. Well, let's do a quick recap of all the stocks we just discussed. Stocks with positive news flow include Vedanta, Devyani, All Cargo Logistics, Keynes Tech, we have PNC Infra, JTL Industries, and India Glycol. While stocks with negative news flow, they include Apollo Tyres, KPI Green Energy, and OMCs.
All right.
Okay, we'll take a quick commercial break here. We'll come back. Amnish Agarwal of Prabhudas Leather will join in with some fundamental stock check. We'll also connect with the management of G Shipping and the global shipping story very much coming into sharp focus again. Once again, stay with us.
CNBC-TV18, embarking on a quarter-century of excellence. Muthoot Microfin Limited on a quarter-century of excellence.
Okay, welcome back. Now, a growing number of cargo ships have come under attack in the Red Sea. Authorities are monitoring tensions in the Red Sea shipping, and shipping firms are now avoiding the Suez Canal. Now, the Suez Canal is, one of the two very important sort of pass-through canals for shipping routes from Asia to North America and other global shipping routes. The other, of course, is Panama, which is already actually facing disruptions. Now, Suez is the more important one out of the two, between Panama and Suez, and this could aggravate shipping rates. And B, it could also lead to fresh supply chain disruption. I mean, if you remember back in 2021, you had this massive surge in container rates. Let's talk to an expert about this. G. Shivkumar is Executive Director and Chief Financial Officer at G Shipping. He's joining us on the phone line to tell us what this would mean. So good morning. Good to have you with us here. Prashant this side. Tell us, how serious is the situation? And shipping liners are saying, including some of the largest in the world, that they will now redirect traffic through the Cape of Good Hope, which is a lot longer. What does this mean for rates out there and supply chain disruptions eventually?
Good morning, Prashant. The situation in the Bab el-Mandeb and the Red Sea is evolving rapidly every day. And yes, I think 4 of the largest shipping lines have said that they will avoid the Red Sea and now use the Cape of Good Hope route, which of course adds a lot of days to the voyages, which is again going to have a couple of effects. One is, of course, to make it take more time to reach, let's say, a Chinese export or of finished goods or Middle Eastern exports of oil, which we haven't come to yet. But for the containers, it'll take more time to reach. Obviously, it makes the market tighter, which makes it, again, rates will probably go up because the market becomes tighter. You need more ships for the same amount of work. But it's rapidly evolving, and anything could happen. It could settle down, or it could get worse.
How will it? There are U.S. forces which are already there, present, right, monitoring these routes, and this has just happened. These shipping liners are saying that we are stopping use of these routes. Will this last? You're saying it's fast developing, but what could change in your opinion? What will get these shipping liners to say that we will use this route once again?
Yeah, so there's a convoying which the U.S. Forces have said that they will do. So that was a flash news of yesterday, last evening or last night, which could give some comfort. And again, it depends on how effective that is, because it's difficult even with a convoy, a drone drone attacks. So we'll have to see how practical it is. It's of course going to lead to delays, and we've seen this convoying happen in the times when piracy was rampant. It does lead to delays.
Okay.
So,
Mr. Shivkumar, sure, good morning. We understand the situation at hand, but what does this mean for tanker rates? Earlier, when you spoke to us, you said that crude tanker rates has shot up to almost $50,000 to $55,000 per day. Where is it currently, and do you see it moving up further?
So markets haven't reacted yet. Markets are still pretty good. Crude tanker markets have been strong. What this does is, so about 10-12% of the world crude trade flows through this area, through the Bab el-Mandeb, the Red Sea and the Suez Canal. Now, if you have to reroute that via the Cape of Good Hope, that means, depending on the voyage that you're doing, between 20 and 60% extra time. Now, if you just apply, say, an average of 40% on 10% of the trade, that's 4% extra demand for ships or reduced supply. The market is already really tight. And a 4% further change in demand-supply balance could make it much tighter and therefore increase rates quite a bit.
So again, how much? Yeah, I'm just trying to understand, like, what is it currently at, the rates as of today? And when you say increase rates quite a bit, what is the indication?
So one is rates have not reacted to this yet. So you have product tankers earning around $30,000, $35,000 a day. You have crude tankers earning between $40,000 and $60,000 a day. Not yet reacted to this situation. And there's been not much change in the last 3-4 days as the situation has evolved. Once you get, and it's very tough in a tight market to see what, suddenly if you have a further disruption, it's really tough to call what can happen, because then it just takes off, right? Then you just have to pay whatever it takes to get the ship if the market gets that tight.
Okay. All right, Mr. Shivkumar, very quickly before we let you go, the smaller part of your business is the offshore revenues. That's the rigs business. Out there as well, it's obviously for a longer term, the lock-in rates. But in the quarters to come, there could be a bump up in terms of revenues. I was just looking at it. It's just 20% of your business, but it's contributing 250 to 260 crores. Do you see this number go up drastically? And I think majority of it will flow down to the margins, right? As of now, you're doing mid-teen margins. Give us some color with the way ahead.
Yeah, the last bit is correct. So whatever rate improvements come will mostly flow through to the at the EBITDA level because costs are sort of inflexible. We have a little bit of inflation, but that's a small part. This will take some time to come through because as the rigs get repriced, all the rigs are on 3-year contracts. So as they get repriced, this will come in. We will get the full impact of repricing only in FY27 of all the current repricing because we have 2 rigs coming off contract in FY25, 1 rig coming off contract in FY26. So for getting a full year of new earnings will take 2 to 3 years.
So gradually on a quarterly basis from 250 crores, we're likely to see this trend up, right, in the next few quarters as a couple of rigs get repriced.
We are past the bottom of the market. Yeah, that's the bottom line. Yeah.
Just a few more questions, Mr. Shivakumar, for if this issue becomes... So, for example, I was looking, the Shanghai containerized freight index, it's up some 10% since the end of November, right? If this were to escalate and it becomes, the rates shoot up, how will this impact, your inventory out there in the market? How much of these are on day rates and how much is it locked in? Your fleet?
No, so we don't have container ships. So
not container. I'm saying that I was just giving an example.
What's likely to happen in the container ship market?
Yeah, not container ship. I was just giving an example that if rates start to for product or oil tankers, etc.
Most of our fleet is open to the spot market. So we have 24 tankers, of which 4 are on fixed rate contracts, and the rest are open to the spot market.
Okay.
So we will get the impact. Yeah.
Okay. And one more question. The large impact as you see it, for container traffic, this passage is much more important, right? I mean, I think the Suez is about 34% of the container traffic. But correct. For product, etc., it's under 10%.
It's about 10%, plus minus 2%, yes.
So the larger delta, the larger impact perhaps should show up in container. Would that be the correct way to look at it?
That's correct. But the container market, the starting point is not as tight as a tanker market. The container market is weak. So, it'll take some time for it to get to full strength. It takes a lot of impact, but yes, the impact of this incident is much more on the container market.
Okay, but the product market is already tighter, so it'll...
it's already tight. Yeah, crude tanker and product tanker rates are already tight. Markets are already tight.
Got it. Mr. Shivakumar, thank you very much for joining us this morning and explaining the implications of this important story. We'll keep coming back to you as this story develops. As you said, every day is a new day, and this is fast changing scenario out there. Sonia.
Absolutely. All right, we'll keep an eye out on GE Shipping, but let's move on. Amnish Agarwal, Head of Research at Prabhudas Lilladher, joins in now to help us with the markets and overall, how to approach stocks. Amnish, good morning and thanks for joining in. Motilal Oswal released a report this morning on PSU banks where they spoke about how, despite the rally, they're still bullish on PSU banks because the earnings quality is improving and valuations remain attractive. Would you agree with this viewpoint?
Good morning, Sonia. The main thing is that in this point, there is, I would say, nothing which is new. It is already well known that whether you look at the NPAs, whether you look at their growth rates or balance sheet, the PSU banks have improved significantly over the past couple of years. And at the current situation where most of the private banks are trading still at maybe say at least 1.5 to 2 times the price to book of PSU banks. So that makes PSU banks still, they are looking quite attractive. More so, I think after a rally in the second run stocks, I think the frontline PSU banks are the ones which should catch up in terms of, say, market action and you can see improvement in the price to book values.
Okay, all right. Amnish, what about the tech space? Kotak has come out with a note today. They are saying that, yes, the Fed's dovish comments were good, and that's what pushed the IT stocks up. But it appears, it's a little bit too optimistic. And that's why they've downgraded a couple of names out there, Persistent as well as HCL Tech. What's your view on tech and which are the stocks that you like?
So the main thing is, as far as your Fed commentary is concerned, I think one should not expect any rate cuts to happen, maybe at least for the next couple of quarters. And given the fact that the entire IT services space in India is glued to what happens in the US as well as in the European market. So the stocks had a rally. And one big reason for that was that these stocks have been significant underperformers over the last 12 to 18 months. Now, given that backdrop, I think, and the sharp rally which we had seen, whether it was the TCS, LTTS, LTI, and all these stocks, I think some sort of a pause can't be ruled out. But yes, if you take a slightly longer term viewpoint, if there is no hard landing in the US market, then tech spend should be back, which should push the growth rate higher, more so from FY25. I think given this backdrop, and I think particularly the stocks like, for example, Infi, TCS, in the front lines, LTI, Mindtree, and LTTS are the stocks which should look good, particularly after the listing of Tata Technologies, which has listed at quite a significant premium to LTTS. LTTS is in a very sharp rally over the last, say, you can say fortnight or so. And I think this entire space is going to be having some action, but intermittent reactions from time to time can't be ruled out, because the actual translation to earnings as well as, you can say, improvement in profitability, that might be at least a couple of quarters away.
Well, it's interesting you bring up the mid-cap IT space, because we're going to talk to a management from this sector itself. Happiest Minds has established a new business unit focused on generative AI, which is definitely the buzzword these days. To discuss opportunities in this segment and the business outlook, we have the management joining in, the Managing Director and CFO Venkatraman Narayanan, and the Executive Vice Chairman and CEO Product Engineering Services Joseph Anantraj is with us. So, gentlemen, morning to both of you. I also want to point out that, you know, the stock, if just pull up the stock once, in the last 1 month, the stock is up about 10%, but it hasn't really done too much this year, similar to what the entire IT pack has been through. So, Mr. Narayanan, you know, before I get to generative AI and what the company is planning to do there, I wanted your view on overall tech spending. Has tech spending improved? Has the decision-making cycle, you know, picked up as well? If yes, by when do you expect to see some kind of demand revival? And how do you see the last quarter pan out?
Well, I'll give you a quick update on how we are looking at the next couple of quarters. I'll turn over the business aspects to Joseph. So this quarter, if you're looking at it in particular, we have, some reduced number of working days and some bit of furloughs from many of the multinational customers of ours. Typically, you have 61 to 62 days in this quarter, but unfortunately, all IT companies are working against a 60-day quarter for this Q3 as we speak. But despite that, I think we should be holding ourselves okay. And we are looking at a reasonably decent year in line with what we have guided. And holding on to the profit margin guidance that we've talked about, which is 22 to 24%. Also, as you see from the other participants in the industry, they're also slowly taking the cost increases, which we had done from the first quarter. They're talking about increases, taking in the campus joinees, all of which we have done until now. So we are looking at a steady Q3, Q4 in terms of profitability. And as for the longer term and the business environment and the generative AI, I'll turn it over to Joseph.
Just one more follow-up on that. You said that you're holding on to your guidance. So 12% was your organic revenue growth guidance for the full year. I'm assuming you're holding on to that. But in terms of deals, right, what we're noticing in the last couple of quarters is that mega deals, large deals are fewer than what we've seen in the preceding quarters, not just for you, but for the industry on the whole. Is that a bit of a concern? And how do you see the trends on deals going ahead?
Talking about industry, yes, deal slowdown is a sort of a concern. But coming specifically to us, we have always followed the land and expand strategy. So we get into a customer. And what really is important for us is the new logo sign up, the new customers that we've onboarded, seeing how much we can go deep into the 250 plus customers that we have and the $55 billion customers that we have. So that's the focus that we have, going burrow deeper into it, while also making sure that the verticals that we have chosen to grow in continue to grow. All the verticals for us are growing in absolute terms. And that will be the focus, continued focus. But as we grow bigger, becoming $500 million in time, yes, we'll have to also focus on that large, big turnaround kind of deals, which is something that's in the sort.
All right. Hi, good morning, gentlemen. I had a two-part question for you. One is, you're looking at hitting that goal of $1 billion revenues by 2031. How much of it will be coming in from generative AI? Point number one. And point number two, we have spoken numerous times in 2023, and you all have said you are scouting for some inorganic growth. but we haven't seen something really closed out. What's the problem? Where is it getting stuck?
So let me take the question on the GenAI business unit. As you know, we set up this business unit around 4-5 months back, and it is being led by Rajiv Shah, who's part of the executive board, and the CEO is Sridhar Mantha, who was our CTO. And we thought we needed a technology person to be CEO out here because this is a techno-commercial kind of space and offering that we would need to go to customers with. And so far, we made pretty good progress. We have at least 30 to 40 conversations going on with customers, both looking at horizontal use cases and verticals, specific to verticals, to optimize some of the work that they're doing. And in the next 5 years, our goal is to, or what we're targeting is to generate, at least 20% of our business from GenAI business services, if not, higher than that. So, I think we made a good start. We have a few POCs going on because the approach customers are taking is to start off with a POC, validate the use case, see what kind of optimization they get, and then get into full-blown implementation. Okay. And on the inorganic growth, yes, we did close an acquisition in Q4 of last year, and this year we were hoping to have something earlier. As we speak, we have a couple of candidates with whom we are in close discussion, hoping we can make progress out there. But we did notice a couple of trends in the in the merger and acquisition space. I think one is there is a little bit of I would say reticence, or I think companies are holding out, thinking that the environment would improve, and so the overall deal flow has reduced on the inorganic side. And the other thing is you still have some of the PE players who are in a way propping up valuation. So that's a couple of things that we've seen, but we're quite hopeful that we'll be able to make progress in the next few months on this front.
All right. Thank you, gentlemen, for joining us, and all the best with your generative AI project. Thanks for speaking about it to CNBC TV18. Let's do one thing. Let's take a quick break. On the other side of the break, we have less than 10 minutes to go before the pre-opening rates kick in. Mitesh Thakkar, Sudarshan Sukhani will join in for some technical trades. Stay tuned.
CNBC TV18, embarking on a quarter century of excellence. Muthoot micro-century of excellence.
Welcome back. Hope you're having a good morning. Well, it's that time of the morning where we get you some technical calls. Mitesh and Sudarshan are with us. Good morning, gentlemen. Hope you're feeling good in the run-up to Christmas. Well, how do you approach trade today, gentlemen? Mitesh, you go first. What's your approach? Yesterday we had a bit of consolidation, but your take?
Morning, Nigel. Yes, there was some consolidation, and the idea is that the uptrend remains, but we are now overbought. We will also see some bouts of profit booking. So it is a buy on dips kind of a market. I think closer to 21,200 would be the first support area. 21,000 is the next major area. So I think anywhere around those levels, if you get the index, I would want to buy into them. Similarly, the Bank Nifty around 47,550, 47,600 is the preferred buying zone.
Okay, gentlemen, morning. Sudarshan, what about you? How would you trade the index and your individual calls?
Well, the index is in a consolidation, that's starting a consolidation. But within this consolidation, traders have to identify dips. They have to use their own resources to say, okay, this is a dip I'm comfortable with, and go long. The chances are by the new year, the Nifty should be higher. So buy the dips in the Nifty and buy the dips in the Bank Nifty. But take your time doing it. Don't rush. ABB is a buying opportunity. New highs there. Stop under 47.60. Balrampur Chini is my only intraday short. The stop above 408. It's a bad chart. Berger Paints is just breaking out. Very interesting. Positional trade also. Buy with a stop under 580. And HAL, which never stops, is now again a buy. The stop under 27.40.
And Mitesh, what about you?
So I have buy calls as well, and one sell call. On the buying side is Berger Paints for me as well. I would want to buy it above yesterday's high of 596. Keep a stop at 587.5. Look for 612, 615 as the target area. Granules with a disclaimer that I have positions there. So Western interest is there. Granules is a buy with a stop at 392 for targets of 425. Exide is a buy with a stop below 300 for targets of 320. And one sell call, that's on Balakrishna Industries. Keep a stop about 2560. Look for targets of 2465.
Okay, thanks a lot for that. So those are some calls coming in. Let's take a short break. On the other side, the pre-opening rates will kick in. We'll also have Rakesh Arora of GoIndiaStocks.com to put focus on the metal sector. Do stay tuned in for that.
CNBC TV18, embarking on a quarter century of excellence.
Co-powered by Century.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. We're counting down to the market opening. The pre-opening rates are actually kicking in right now. So it looks like it's going to be a day of consolidation, at least a morning of consolidation. But lots of stocks in focus. So let's get straight to it. Amnish Agarwal is still with us. He's the head of research at Prabhudas Lilladher. Amnish, the big talking point is the start of rate cuts in 2024, right? Both from the US Fed and perhaps the RBI following suit as well. All these rate sensitives, whether it's real estate, NBFCs, auto stocks, do you see more upsides? And if yes, which is the pocket that you're most that you have the most conviction on now?
Okay, you see, as far as your interest rates are concerned, there's a fair bit of probability that from the post, say, June next year, we might see some action on that front. So with respect to that, obviously, I think financial will be the ones which will definitely be in the limelight, whether these are banks or your NBFCs. They are on one hand. On the other hand, if you look at, say, the second bag, which is real estate, I think real estate could get a leg up from this because the EMI costs actually go down and the affordability of that goes up. The third one which you talked about is autos. I think my sense is that autos, we have seen now the momentum actually being there, both in terms of, say, your commercial vehicles as well as PVs from quite some time. And two-wheelers are just catching up. I think if the rate cuts happen, it will be more beneficial for the two-wheelers because that market has not been going from the past couple of years, followed by, say, PVs and your commercial vehicles. Now, as far as investment is concerned, I think all these sectors, they have been doing well. So particularly if you are looking at autos, I think still your PVs, it makes sense to buy select, you can say PV stocks like your Maruti is there. And maybe you can say in two-wheelers, one can look at, say, maybe a Hero at the current juncture because the demand level actually happens. So similarly, I think banks and real estate also, yes, we will selectively get stocks from these which can actually outperform. But if the rate cuts happen, there will be, I would say, a broad-based, you can say, uptick in all these sectors.
Got it. Abnish, any thoughts on Z? You know, there's a story this morning talking about how things are looking a little precarious. Z's asked for an extension, whether Sony will agree to it, not. Deadline is nearing. Seems like a bit of a binary situation. What would you advise those who are holding on? And there have been many who actually bought in the hope that this will culminate and valuations will re-rate.
I think the entire Z story was, you can say, banking upon that ultimately the merger will happen, more funds will come, you will have a, you can say, new MNC parent, and so the overall level of corporate governance and transparency in the company will improve. So if the merger doesn't go through, definitely it is going to be negative for the stock as well as for the shareholders, at least in the medium term. Because the entire sector is in some sort of, I would say it's in a big transformation stage, where on one hand you have got an aggressive Jio, and then we are having Disney Hotstar. And plus the way your OTT market is actually shaping up, it is very difficult for any player with, you can say, any weak positioning in that market or even in the overall context to be making money in the longer term. So in the near term, I think it is a very catch-22 kind of a situation. And definitely there could be, you can say, some near-term correction in the stock price if the merger definitely doesn't go through. So for the holders, I think I would say very difficult actually to give a call because it's a event-led kind of a situation. But if the stock say moves up from there, then one can look at say booking some profit. Okay, because the near-term uncertainty is there. But if the merger actually goes through, then definitely there could be, you can say, some reasonable gains on the table over the next 3 to 4 months.
Okay, all right, Abneesh, always good hearing your thoughts. Thanks for joining in and filling us in with your take on a whole host of stocks as well as sectors. By the way, in pre-open, a couple of stocks are buzzing in trade, and in fact, coming from the metal space, you have JTL actually. Over there, the promoter entity is infusing big money at a premium in comparison to yesterday's close price. So that's why that stock is approaching its 52-week high. It's not yet there, but almost there. I think it hit this 250, 252 mark in October. And from there, it saw a correction, but now because of this fund infusion, it's higher. And the other one is Vedanta. You know, that one as well is up and about in today's trading session because of the big dividend payout that's come about yet again. Rakesh Arora joins us, founder at goindiastocks.com, to help us out with some quick analysis. Hi, Rakesh. Good morning. Well, metal stocks have been on fire. Let's talk about Vedanta first. You know, you always bet on Mr. Anil Agarwal coming up with the goods, you know, particularly in the near term. Default, I think it doesn't really come about because somehow or the other, whether it's dividend, some technical fees or whatever it is, but he comes up with the goods. What's your view on the stock though? Vedanta is now at 260 rupees. A couple of months ago, it went down to around 210 rupees. So at 260, what would you do?
So, see, you know, currently there's a lot of news flow that, you know, Vedanta might be able to tide over their bond repayments. And they are looking for a composite solution which will take care of, you know, even the payments which are coming up later in next year. So all this lifts an overhang on the stock, and there's just a normalization that is happening. So I would say that, you know, probably there's still a little bit more legs out there. Also remember that they have that restructuring coming in, which can also create a little bit of hype. So I think worst is kind of a little bit over for Vedanta.
Would you be a buyer at these levels? Would you be a buyer, Rakesh, at these levels?
So Nigel, you know, metal stocks have been making a huge, you know, rally in the last month or so. And it makes kind of, you know, normally it makes sense because, you know, dollar index is weakening and you have, you know, probably rate cuts starting next year, plus China stimulus. So all this kind of makes sense in terms of in a normal environment. But there are two basic ingredients which are missing right now. One is that valuations are not cheap, meaning investors become very smart. So they never, the metal stocks never saw the dip normally they see during, you know, lean season. So this time valuations are much higher. And number two, demand is missing. Despite all this hoopla and everything, the inventories are piling up and companies are not able to sell material. So I think market has run ahead of itself in the near term. Probably there will be some pullback.
Okay, all right. Well, Rakesh, I wanted to ask you about this combination, right? PSUs have been the theme to play, and you have metals as well. So if you get that combination, then some of these stocks have done very, very well. But sometimes it doesn't end very well. You know, Nalco, SAIL, Hindustan Copper, they have been the biggest movers in the last 10 days or so. What's your view on these names? Is the street expecting some divestment, or is it purely the metals valuation play that we're seeing out here?
So, I mean, there's a renewed confidence in PSUs being able to match up their performance with private sector. And plus, PSUs were always, meaning they were always trading at a cheaper valuation than private sector. So there has been a bit of catch-up, but I think there's too much of optimism built into this. So I won't really advise investors to, you know, get into these stocks now. They are extremely expensive.
Okay, just one final question. Rakesh, hi, good morning. On Tata Steel, it's had a fairly decent run. I mean, if you map the past 6 months, it's come back 20% growth over there. In the last 1 month, about 10%. Do you see more upsides in the months to come?
See, I can talk generally. As I was saying, that rally has gone overboard, and that includes Tata Steel also. So I don't really ascribe to the view that there is a super cycle or the bull market, you know, awaiting us in 2024. So I think there will be a pullback.
There will be a pullback. Okay, all right. What about this big deal that took place overnight, Rakesh? Nippon as well as US Steel. It was done at a big premium. On an EV upon a EBITDA basis, it appears it's done at around 7.5 times. But on an EV per ton basis, it's done at around $700, $750 per ton, which is actually at a bit of a discount in comparison to what some of these stocks are trading at. Any kind of read-through for Indian companies?
So, see, US market is a very protected market, and there's a lot of consolidation which has happened there. So I don't think there's any major read-through for Indian markets per se. I think it's it's a different ballgame altogether, US steel market.
Rakesh, since we have you on the line, we were just discussing, we had the management of GE Shipping with us on this, on the disruptions in the Suez Canal, the Red Sea, etc. It's important for container, but it's also important for products, tankers, etc. Any thoughts on what this could mean for prices, commodity prices?
So largely, I think this route is largely for crude oil, and we haven't really seen any correction, action on the crude prices as such. There is a shortage of crude tankers globally, and now with the extra miles that the ships have to travel, the freight rates can actually go up. But it's more, I think this route is more linked to energy rather than metals, because metal is largely flowing from Australia, Canada, etc. to rest of the world.
All right, Rakesh, we'll let you go on that note. Thanks a lot for joining in and talking about the metal space. Let's do one thing. Let's get back to the market now, which has settled absolutely quiet, but now it's actually picking up pace. So, the headline index is up almost 60 points. Sudarshan Sukhani is back with us. Sudarshan, looks like some of these oil companies are going to do well this morning. There's ONGC, Reliance that's topping the charts, and also banks are coming back. What's the big call at 9:10?
The big call is to consider buying HAL with a stop under 27.40.
And Mitesh, what about you?
Yeah, I'll go with the buy on granules with a stop at 392 for targets of 435.
Big mover this morning in pre-opening is Reliance. So let's find out why this stock should be on your radar. Sonal is here to tell us more. Sonal, over to you.
Well, there are two brokerage notes coming in on Reliance Industries, both of them positive. In fact, UPS has gone ahead and they've increased the target price on the stock to 3,000 versus 2,850 earlier. They say consumer businesses are in focus. The leverage fears, they are overdone now. Consumer business could contribute around 85% of incremental EBITDA over FY23 to FY26, and this will take their segment EBITDA from around 49% in FY23 to 58% in FY26, both the consumer businesses, that is. And improving earnings could generate sufficient free cash flow to reduce debt beyond FY24 because of all the capex that the company had announced. New energy opportunities also are not fully priced in, and that SOTP would be close to 225 rupees a share, so they are quite bullish on Reliance Industries. JP Morgan says that gap between Reliance Industries standalone and consolidated profits has increased substantially from 8,400 crore rupees in FY20 to around 22,400 crore rupees in FY23. Telecom and retail profits, they have ramped up, leading to this gap that we are seeing. There are 350 standalone JVs, associates or subsidiaries which are actually leading to this difference as well. And 133 of these companies, they have reported profits for this year. But they say that yes, stock has been under pressure. It has been range bound for last couple of trading sessions, and this could be largely over now with new triggers coming in from FY24. They maintain their overweight rating on the stock.
Okay, a minute and a half left. So let me get Mitesh in on this. Mitesh, Reliance at this price, 25.50, does the risk reward still look favorable for a for a trader?
I would believe so. I think, this is a stock which is now showing signs of waking up after a good break. There's some pivot at 25.50, 25.60 levels, but I think the earliest swing highs, which is closer to about, the highest closing which we got in July was 25.82. I think that is the first target, and I think beyond that we are looking at this rally extending by a significant amount.
Okay, there's a minute to go for the market to open. So let's just get to, just the overall market cues. Remember, it's been quiet. The Nifty consolidated around that level of 21,500 or so. Today looks like we could perhaps put on some more weight. A couple of things to watch out for. The US market cues are very quiet, so not too much happening. Flows have also thinned out. But perhaps rate sensitives are what you can look at. Yesterday, we did see a bit of profit taking in names like in the real estate space, but this morning, maybe some of them could be in focus. Broader markets have been outperforming the benchmark indices, so that is something that could continue this morning. Banks, IT, real estate took a breather yesterday, but will they continue to see an up move this morning? So that is a big question to ask. The US 10-year Treasury yield is at the lowest level since July, so a lot of cues are still favorable towards the equity markets. And the big theme that we're looking at is a rate cuts. The fact that perhaps heading into 2024, traders, in fact, are pricing in almost a 70% chance of a Fed rate cut in March. And if that happens, if and when that happens, rate sensitives will definitely be in focus. All right, here's the first take on the index. Positive, up about 30-odd points. Sensex is up 75 points. The Bank Nifty has opened in the red. So, not great for the Bank Nifty, to be honest. The rest of the market is sideways with a positive bias. ONGC, Sun Pharma, Nestle and Reliance are your top Nifty gainers. Auto stocks also doing pretty well. M&M, Eicher Motors are in the green. Infosys is trending in the green right now. Coal India is up about 0.3%. So these are some stocks that are holding on to the green line. ITC, Wipro, Divi's Labs, Bharti Airtel are a couple of other stocks that are in the green right now. On the downside, Titan is under a bit of pressure. SBI Life is just taking a bit of a breather. Kotak Mahindra Bank, Bajaj Auto, a bit of a breather there. And Asian Paints as well, flat with a negative bias. But suffice to say, this market is in consolidation mode. It's quietened down as we head into the end of the year. So there's not too much movement on the headline index, just hanging on to those gains of last week. 21,400 is being supported very firmly. Devyani International, burgers getting into the Thailand market, all of their brands entering over there. So 5% higher on Devyani International this morning. And other than that, anything else in the broader markets is looking good?
Well, I'm looking at Apollo Tyres, Sonia. The last full week, the street was sensing there's going to be a large trade that's going to take out there. Yes, the trade happened. The problem is that it happened in the pre-market. If it happened in normal market hours, then in fact, those shorts would make some money. But now the shorts are getting squeezed out. And that explains why all those short positions are scrambling for cover. And that's why that stock is up close to around 7%. That's one of the biggest movers in today's trading session. Add to the list a couple of other big movers. You have Vedanta, one of the top traded stocks today. That's up close to around 2%. Vedanta Limited declaring some dividend. Bulk of it will go to the promoter entity. Vedanta Resources gets some money and avoids any kind of default, any kinds of other trouble with them. So that's why that stock is up. JTL Industries, well, a big preference issue is what they did. Massive dilution, close to around 15%, at a big premium as well. The stock has run up in the last few days. It's almost at a 52-week high in today's trading session. So that one is well up close to around 3%. Other big volume buzzers, you have Delta Corp as well that's buzzing in trade in today's trading session. So that's a big mover. And Sterling and Wilson up close to around 5% as we speak. Z on the flip side, that's under some pressure. That's down close to around 2.5% odd. Sony, though, is clarifying to CNBC-TV18 they've not agreed to deadline extension sought by Z. So that's why that stock is under some pressure. And, that's down close to around 3% as we speak. And IRCTC, after the big run that we saw yesterday, some brakes being put on here, down close to around 1.5%. Prashant, what else?
Nigel, on that flash, the most important word is yet. Yeah. Have not yet agreed to a deadline extension sought by Z because people will be hoping that, this is a matter of time. If not, that's a huge negative, right? For Z. We were just talking about Z with Avnish. And Avnish, of course, was telling us that the hopes, of course, were that this gets consummated quickly. Cash comes in. There's a re-rating, a global brand, etc., etc. But that story, of course, will only be will go through if Sony agrees to the extension. That's the first step now. And this is what's coming through from Sony as far as comments to CNBC-TV18 are concerned. Just a few other names I want to just highlight before we move any further. IREDA is coming up with a 4% pop. It's got humongous volumes. Second largest volume traded name. So 2 days of some correction and today back up again. Devyani, of course, we mentioned. Again, the gains are 7%, but look at the volumes. Sterling and Wilson, I think it's another circuit day, is it? The QIP, of course, got done. Sterling and Wilson Solar, 452, fourth largest volumes on across the board on the NSE right now. Dixon comes up. There's a CLSA note this morning. I think it just talks about the IT hardware opportunity and how Dixon perhaps is well poised to take advantage of it. GTL Industries, I think we highlighted 3% on GTL. Amit Jeswani, who runs Stallion Asset Management, he was with us yesterday on the program and Closing Bell, and he was saying that they've been buyers in GTL. More on this a little later. Chennai Petro is up 2.5%. GIC RE is up about 3.5%, 330. There is PNC Infra, a stock which Vivek highlighted in the morning, which is up about 4% as well. So there's a fair bit going on with volumes. Right out of the gates, there is no dearth of volumes at all. Oil India is up about 2.5%. So these oil sort of names, oil and gas names are starting the day up, at least right now. Cairns is up about 2%. Just a few more names. Jindal SAW is up about 3%. I mentioned Chennai Petro, but there is MRPL, which is up about 4% as well. So is it the shipping story? Is it, fears there? I'm not sure, but some of these names are starting the day up. Siemens saw this massive move yesterday. 7%, closed up 7%. It's starting about 1.33% lower. And look at Max Healthcare, the hospital name, which starts about 2% lower, 2.5% lower as well. Sonia?
By the way, I just was looking at Zomato and the trajectory, right? I mean, the year has belonged to Zomato. Just look at it. It's at a fresh high this morning at 130. Who would have thought this year Zomato is up 120%? Of course, the movement started after its earnings, if you remember, the upgrades that came in post-earnings, the fact that Blinkit was doing very well. And this is one stock that has had a phenomenal run. So fresh high this morning. So I couldn't really take my gaze off some of these platform companies that have been doing really well.
We spoke, if you remember, we sat right here and spoke.
Yes.
I mean, Ramdevji, of course, of Motilal Oswal, took us through that conversation, and he's, of course, remains extremely bullish on this business, the business model, and of course the company as well. So 131 on Zomato is where we're at. Ajay Srivastava is Chief Executive Officer at Dimensions Corporate Finance Services. He's our market master of the day. Ajay, good to have you with us here. Thank you very much. I'm surprised you're still around. You're not off on your vacation.
Good morning.
End of the year.
Good morning. I tell you, when it pours, you collect the water. You don't run away from it, right? You don't put a raincoat, you don't run away. When it pours, you collect it. So I think this is one season which is just incredible, not only from the investment side, but from the corporate, our banking side, investment banking side. It's just amazing what the year has come out to be, I think. And yes, we will try to run away, but well...
No. I was just joking, Ajay, please stay. We're all here. And we're all going to be here. So please stay.
If we got to be here for this year in the season, silly season, then I think we got a problem. Then we got a problem. We need to enjoy the money, my friend, before it evaporates. It's, paper money.
I agree with you. I mean, not just this year, right? Every year. I mean, towards the end of the year is when you can actually take some time off. But season's greetings to you, Ajay. What's the big plan for Christmas and New Year this time?
I think the big plan is to just relax, count your earning, and stay in a place where nobody can find you.
Well, I'm going to say it in...
Sorry?
I'm saying I'm going to, in a full filmy time, we're going to find you.
Believe me, I found a place where nobody can find. Where there's no connection, there is nothing there at all.
Tell us also, so we can also run there.
I'm telling you, it's in the middle of Kerala, okay, and no connection comes there.
Wow.
Absolutely blissful.
Kerala.
Is it in one of Prashant's plots? I heard that Prashant has some lovely property. Are you guys going together?
A lot of market men keep talking about these plots that Prashant has.
We never get invited.
We have not got invited till now. Anyway, hopefully 2024.
Complete fabrication. But Ajay, talk to us about the markets a little bit. I think we should get to that as well. How are things looking? Good for more?
I think things are looking good. But what we have done in the last 2 weeks is that we have actually pruned some of our stock holdings. I think some of the stock which has gone up quite substantially may not back up with the fundamental earnings. I think, and we have analyzed that almost about 500 companies in India that are in the universe of BSC that would definitely, which were in the active universe zone, we'll take some money off some of them, not invest in some of them. So this has been kind of the last 2 weeks. Prashant has been a time to say what we will not invest in, that is one, what we will book profits into, and what we will add on, and that's the theme. But by and large, the theme is that don't change much of philosophy of investment. The same themes continue, but definitely prune your expenditure, your investments into companies that perhaps have run too far ahead of themselves. So I think this has been a kind of a last 2 weeks has been of pruning down more than adding up.
Okay, well, there is a statement that's come from Sony, so we'll get to that in a bit. Sony's statement has come to CNBC-TV18. So Mangalam will be here with us to just give us an update on that. Z Entertainment now is down almost about 2.5%. So we'll come to that in a bit. But before that, Ajay, this year, we were just chatting about it. This year has belonged to some of the laggards, right? I mean, Zomato, for example, it's come into its own this year. Profitability has come back in a big way. The stock has doubled. But do you see this as a structural up move in some of these platform companies?
Of course, it is a structural up move, Sonia, for 2-3 reasons. One, the large mass of Indian investors which doubted such companies and said, they are the cash burners and they're not going to do anything at all. So it's kind of now people are chasing the stock because lots of portfolios didn't have it, didn't believe in it. We must understand that we have a legacy of investors who are, who can understand steel, cement, but don't relate to these companies, partly for a valid reason that they couldn't understand loss, etc. But in terms of business proposition, absolutely amazing. In terms of monopoly status, it's a tick mark in the boxes. You can't get a competition to come in apart from, say, Zomato and Swiggy. I'm not saying invest either, but I'm just saying the fact that you cannot get competition in this sector in a hurry at this point of time. You've seen how Nykaa has taken the lead in the fashion business, and how Reliance, a old, a physical, one would say company of the old type, is trying to catch up with them. So it's not going to be easy. But, and as they always say, and what happened in the political landscape, you need to change your portfolio. You saw what happened to the two chief ministers, right? New guys came on board. So if your portfolio is not carrying new guys, I think you're not going to do service to your portfolio in the next 2-3 years. It's ridiculous to have the same old companies in your portfolio. The world has changed. Indian market has given you 300 new companies in the last 2 years. You can pick and choose which one you like. But some of these, which have got real scale now, they are phenomenal, and they're going to go higher. Just, think of the scenario, 5 years down the line, this company is serving, instead of 130 million customers, it serves 400 million customers. The scale and magnitude of Indian population is just amazing, absolutely. So I would say, if you don't have it, take the new age companies in your portfolio and just structure yourself to believe that you need to get 30-35% of your portfolio in new companies, new areas which have come up. Look at watch retailing. We never knew it would happen. The company's done phenomenal. Airport lounges, phenomenal, absolutely. The new sectors coming up. So I think new age, I would say, define it a little beyond just the cash burning companies, but also saying some of the new sectors have opened up which are never available to Indian investors. So I think your portfolio, definitely, we have said to our team very clearly, 35% of a portfolio has to be in companies which are listed in the last 3 years.
All right. Ajay, very quickly, if you could tell us, what would be your asset allocation as of now? Personally, I'm keeping my SIPs going, but I'm also, buying some gold sovereign bonds as well. But I'm buying it for a longer duration. As of now, approaching into 2024, what would your allocation be, say, into equities, gold, real estate?
My dear friend, look at my hair and your hair, right? So my concept of life is very different than your concept of life. At this point of time, we are enjoying life by playing literally, to be fair to us, honestly, we have fair amount of real estate investment at this point of time. So if you look at, the allocation to real estate continues to grow at this point of time. So 30% or 40% of the money which we make, it actually goes back to real estate at this point of time. Balance, we're done with gold. I think gold, we got whatever we have. I think it's all equity at this point of time. There's reasonable amount allocated to gilt fund, but not such a significant to make a merit a mention. But there's a reasonable amount now parked in gilt funds to hopefully ride the next wave and give us liquidity as we need in equity markets.
Okay, luckily you only spoke about the hairstyle. I was worried about you get into the bank account, then I would be in trouble. Just stay with us for a bit. We need to address that story coming in on Z, and Sony has given some clarification. Mangalam joins us. He's got us all those details. Mangalam, go ahead.
Well, the latest that has happened is that we've heard from Sony, and this is on Z's notice that came yesterday, which asked them for an extension to the deadline for their contract itself, or the merger agreement that the company has had. To that, Sony has said that as per the contract, Sony is required to start these conversations, but it has not yet agreed to a deadline extension. And that's an interesting one because the deadline is very near itself. What will make Sony agree to this? Well, they're saying that, they look forward to hearing Z's proposal on how they plan to complete the remaining critical closing conditions, of which one of them, I presume, would be that of leadership. Puneet Goenka, being the leader of the combined entity, whether Z would agree to, to go in favor of the merger and not just the leadership itself is something that we will have to watch out for. Until there is clarity on that, the remaining critical closing condition, Sony is unlikely, to go ahead and give their permission for the deadline extension itself. So that's a story that we will monitor closely because it's the 19th of December and 21st is where the deadline expires.
Okay, Mangalam, thanks very much for that. That's Z in focus and under pressure. Ajay is still with us. Ajay, any thoughts? Z, you heard Mangalam outline what's happening here?
I think it's a greatly avoidable stock. There's so many better things happening there. And it's a binary. If it merges and if the leadership is same from Z, then why would I buy even this combined entity? You know, it's all about buying leadership. This is one company where if the transition happened from Z leadership to Sony and they combine, it's certainly not on my buy list.
Okay, it's certainly not on your buy list. What is on your buy list now? Where are your sights set? Because there's so much happening, right? I mean, there are renewable energy companies, power companies coming back in a big way. There's defense, there are commodity stocks, autos are coming back. So where do you see alpha being generated now over the next, say, 12 to 18 months?
I think the alpha, in our view, would come really from the stocks being driven at the mutual fund level at this point of time. And that alpha would come perhaps again back to the same. That's why I said, Sonia, the thesis of investment does not change in India, given what scenario. Whether it's a defense, whether it's a railways, whether it is a capital goods, I think that's the more important one. The thesis remains that you stick to these companies, and whenever you get a correction, you just go into these companies. The retail is out at this point in time. The only one which did a good job this year and which is out of our favor at this point in time is pharma, because that is too expensive given where the valuations are and what we are seeing in the US market at this point of time, whether it's a biotech sector, whether it's a pharma sector, all under pressure at this point of time. So therefore, pharma definitely is out. So that's why I said important to see what you keep out of it. Retail is out of our portfolio, except for one large company, that's it. But then focus remains where it was earlier. Nothing new. Unfortunately, nothing new for the investors to say, you know, what new can come. The only thing we're ensuring is wherever we see government policies impacting our share price, like what you saw in sugar, we were zero in sugar. We have kept our list and says these sectors we want to keep away because one move, it wipes out your net worth. You know, you hate it when on a day when the market goes up, if you are a sugar company share owner, you see your stock price 7%. It's not 7%. You feel miserable no matter what you made in the other portfolio. And I think this is one year where you don't want to be miserable when the market is giving you 30% returns.
So, okay, since we're talking themes, right, there's also this artificial intelligence theme that everyone is playing. And we just had a word with the management of Happiest Minds. They're doing something in generative AI. There's Zensar Tech, Affle, Cyient, and stocks like Cyient are sitting at fresh highs. Is this a theme that you would play?
See, you know, this theme we have played in the US market. It's worked very well, wonderfully well. So I would still believe that if you want to play this kind of theme, you are best advised to put in the US market because of much better companies, much smarter companies, and they give you, you know, you're talking alpha returns. Look at what happened to the largest 5 companies, their tech companies. That's the real alpha coming out there. So, you know, if anything will happen to greatly to Indian companies, they will lead the charge again. So I would still believe that the AI, technologies, etc., before they become money spinner for Indian companies, you'll get a better way from the US companies. You know, Indian companies also have a legacy business. So yes, incrementally AI business or whatever it comes to them. And it's all confusing. What is AI? What is generative? What will classify? What is digital? It's a model at this point of time. But what we do not see, and I think that's important part, is increased spends out of the US into the technology sector. That's why Indian companies. That's not happening. Same for pharma. That's not happening. So I think one would be advised that if you want to play this theme, US gives you so many more options than India. Play it there. India is going to derive a 5% odd benefit from it, nothing more. 95% is going to come in the US. So better focus your money there than focus in India.
Okay, Ajay, thank you very much for joining us. We wish you all the best. It's an enjoyable chat as always. And as I wrap up, I'm Googling areas with no phone connectivity in Kerala. So, so I'll message you.
I'll share with you. I'll take you when I'm not there.
All right. Okay, that's a googly. Thanks very much, Ajay. It's a pleasure having you with us here on CNBC-TV18. I think the market is doing nothing. I mean, 15 points higher, but there's a lot happening at a stock level, which is what we will get to in just a bit. 3:1 is the advances to decline ratio. 1,500 stocks are higher, and you got about 500 stocks, 550 stocks, which are lower. So it's broadly a bullish bias out there. Sonia.
It just goes to show how much time all of us spend on our gadgets, right? On our phones, on our laptops, that you need to look for places where there's no network, and that's a privilege. And that's a luxury that people can't afford these days. Well, all right, let's move on. IRB Infra, you know, as we were telling you, is the stock on our radar right now. The company has, the IRB Infra Trust has bagged 2 projects from the NHAI. So Anil Yadav, who's the Director, Investor Relations and former Group Chief Financial Officer at IRB Infra, joins us now to talk about that. Mr. Yadav, good morning. Always great speaking to you. You know, first of all, congratulations on emerging as the highest bidder in both these projects, the packages of NHAI. Can you tell us, are both these projects part of the private InvIT? Is there any benefit of this work that will come to the listed IRB infra entity? And what is the ownership structure? What is the kind of payout benefits that we're looking at from these two projects?
Yeah, thank you. Good morning. With respect to the private InvIT, it's a 51% owned by the listed company. Apart from the ownership, that whatever the distribution will come, 51% will flow to IRB and balance 49% will go to Government of Singapore. And apart from that, EPC and O&M is done by IRB for these projects. If you look at these two projects put together, would have added in range of 6,000 to 7,000 crores of order book in the order book of IRB.
So you had earlier said that you will do 2,500 to 2,600 crores of revenues for FY24 with an EBITDA of 1,500 to 1,600 crores. Are you on track to doing that? And, you know, what is the kind of, I mean, are there any further assets that could be transferred to the InvITs over the next couple of months?
Yeah, you are correct that we have talked about initial 10 assets will have a revenue of around 2,400 to 2,500 crores and net revenue of around 1,800 crores and 15 to 1,600 crores of EBITDA. But as you are aware that we have added the Hyderabad ORR from the August, the number will improve further.
Okay. All right. Hi, sir. Morning, and thanks so much for joining in. Do you stick to the guidance that you had given us earlier? You were expecting, I think, 10 to 15% growth in the EPC business, 15 to 20% growth in the toll collection business. You consider the price hikes out there. Do you stick to this guidance?
Yes, I think the growth in toll business will be upwards of 20% because we are seeing a very healthy growth during the festive season. And we also report the monthly number. There we are seeing the healthy growth. Probably it will be towards the higher band of the guidance what we have provided at the beginning of the year.
Okay, all right. Got it. Can you tell us this refinancing exercise that you are planning to do for some of your SPVs? Can you tell us what is the total refinancing that you've undertaken and what will be the interest cost savings that you're looking at in the second half of the year and also in FY25?
Over the last 1 year, we have done a refinancing of 10,000 crores debt and saving of 110 basis point on that. So roughly 110 crores of saving on the interest cost. And there is almost 1,500 crores saving on the repayment. And that will be translated roughly 300 crores per annum. Almost 400 crores of cash flow saving due to refinancing of the debt at the InvIT level.
Okay, all right. So this toll business growth that you spoke about, right? Upwards of 20%. Is that something that you're looking at in this year? By the end of FY24, or can you hold on to a 20% plus growth in the toll business in FY25 as well?
If you look at IRB plus the private InvIT, as we have talked about TOT 12 and TOT 13 will start soon, probably over the period of 6 months, and those will be contributing the revenue for FY24. Probably the growth in the toll business, IRB and private InvIT put together will be in range of 15 to 20% for the next financial year as well.
Okay, all right, we will leave it at that. Thanks a lot for joining in, and once again, greetings of the season to you and your team at IRB Infra. Let's take a quick break on that note. The market is very quiet, very flat, so not doing much at all. In our special offering, Big Winners of 2023, today we'll speak to the management of Wellspun Living. Dipali Goenka of Wellspun Living will be joining in to discuss their business momentum. Later in our special segment, Charting Trends, Sachidanand Uttekar of Trade Bulls will help us decode charts in the market. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
Co-presented by
CNBC-TV18, embarking on a quarter century of excellence.
Well, welcome back. You got the market, which is not doing very much. It seems like a bit of a repeat of what we saw yesterday, a middling kind of day. Although yesterday, by this time, things were a little sharply down. And then, of course, there was a full recovery which was made before a second dip happened in the second half of the session. 21,385 is where we are at on the index right now. This is, of course, corporate radar, and we are focusing on the big winners of 2023. Today, we'll be speaking with the management of Wellspun Living. The stock, by the way, is up 100% plus in this year. So far, of course, with a few more sessions left. We have the Managing Director and Chief Executive Officer of the company joining in now to take some questions. We have Dipali Goenka, who's with us. Dipali, good morning. It's been a while. Thank you very much for joining us here on CNBC-TV18. Prashant this side.
Hi, Prashant.
Hi, Dipali. Tell us a little bit about how demand is shaping up. Both locally and, in the export markets as well. And talk a little bit about exports, because we've been hearing this coming recession in the US for a while now, which now no one is expecting. Everyone is saying, well, it's going to be just fine in 2024. So where does it leave us? It's not as if your exports suffered greatly. I mean, they've actually grew at a healthy pace. But talk to us about the demand trends.
So let me just give you a perspective. So while, yes, people were talking about the recession in the United States, and I continue to say that United States has always been a resilient economy. It consumes around 34% of world's home textiles. And you have a per capita of around $80,000. I mean, you can imagine that kind of a consumption that you have there, right? So if I look at the holiday season, I mean, in November itself, it grew by 3 to 4%. And that has been amazing. I mean, 200 million people shopped that weekend of 5 days, right? It was around $957 billion to $966 billion was the growth that we saw, around 3 to 4% in the terms of the percentage. And it is also owing to the whole the job data and the wages, because I think the consumption is to that. But yes, discounts have been the run of the day. The Black Friday was a sure hit. So definitely you see that coming in as a trend. And going forward as well, I think with the Fed taking a call for, and that's already come and you would be aware of it, we saw the Fed rates going up. Now they're going to be going down. So definitely that's going to up the whole discretionary spend. So definitely that's when you talk about United States. Now, when I come closer home in India, you see a 5x growth in the kind of, the earnings of over rupees 5 lakh, and that is driving India's consumption. And it's been a very mixed bag in India, if you look at it. Premiumization, the luxury goods were very good. The rural was a little low. Q1, Q2 was a bit slow, Prashant, but I feel it's going to come up because, with the elections coming up, the rural will definitely have an upside as well. So, yeah, having said that, I feel that going forward, the recession is, behind us that way. But I mean, the Red Sea fiasco that's happened now. So we don't know any other black swan event that comes through. So, yeah, looking at today, we are pretty good. But I think as organizations and corporates, we have to brace ourselves always and be ready.
Absolutely. And you've done a great job at that up until now. Dipali, hi, good morning. Good to see you in. This is Sonia here. You've been a pioneer player in this entire bath linen, bed linen space, but now you're getting into flooring as well. So I want to talk a little bit about flooring. It's just 10% of your overall business currently, but what's the game plan? Do you plan to sort of take the contribution much higher in terms of the operational benefits that you get? Is it much better than your traditional business? And, how much are you doing in terms of investments here?
So I think, Sonia, first of all, we invested around 2,300 crores in this business in the flooring business. And it is one of the most progressive modern plants in this side of the world ever, right? Because usually the countries are like United States of America or, Middle East or China. Today, the advantage that we see in this flooring business is the upside from the China Plus One, because everybody's been talking about traceability in flooring as well. And that is kind of an upside that we see in the United States of America. This business grew 57% this year. I mean, we're looking at year-to-date Q2. And we actually had a kind of a EBITDA of around an upper single digit. So this is where, because we could leverage our capacities, which are around at 63%, used right now. But I think the opportunity here for India as a sourcing and kind of a sourcing hub is increasing. I mean, you see Walmart committing, Uniqlo committing, Toys R Us committing. I think everybody looking at India, and Lowe's also committing to India. So I think the opportunity in flooring business globally is a very important one. Look at GCC, the kind of growth that we see there as well, Sonia. And of course, closer home, India. India, there were around 500,000 luxury market, the housing that was sold. Again, I mean, now looking at the bottom of the pyramid as well. Now look at the government policies that are coming in the housing market, cheap housing. I think we see that kind of a boom that's going to definitely come and be there and retain us. So yes, that's where it is. And by the way, Sonia, we are not a traditional business. We talk about ourselves as home solutions, as Welspun Living.
Of course, you've evolved. I mean, from home textiles to home solutions, now to flooring. So you're definitely keeping up with the times. But can you help us with some numbers on the flooring business? On an average, I think your quarterly revenues are about 250 crores or so. Does that mean you can end up the year FY24 with about 1,000 crores or maybe, 800 to 1,000 crores? Are you looking at that? How can you build on to that number in FY25? Just trying to understand what the growth rates could look like in flooring.
Flooring, I'll tell you one thing. India is, again, a very big market for us. And of course, globally as well, GCC and the other countries also are coming to play up. Flooring will maintain a steady state as we have committed. Now, if I look at 2026, I'll give you the numbers of even Welspun Living, we'll be around, 15,000 crores in, our top line. And flooring being around 2,500 crores by 2026. Retail being, contributing around 11% of this 1,700 crores, and a bottom line of, say, steady state 15%. So, and a CAGR of 23%. So I think this is where we see ourselves, Sonia. So definitely there is going to be, we are at 60% utilization, and there's a huge opportunity and huge headway there as well.
All right. Good morning, Ms. Goenka. Nigel on this side. I recall coming across to meet you a few years ago, and you laid out a plan. It appears pretty much you're on track with regard to what you had set out. So pretty good going on that front. Now, in the near term, that's FY24 as well as FY25. I think in the last analyst call, you were guiding for low teen growth, maybe around 10 to around 12% approximately, with margins at around 15% and maybe debt coming down as well, as you've done some debt reduction. So give us those numbers. In the near term, that's 24-25. Do you stick to that low teen growth? Do you want to upgrade that? And also the margin front, will it be at around this 15%? Can the net debt level come down to around 1,000 crores? Please go ahead.
So Nigel, hi. So we will maintain our numbers of a steady state 10% because you look at a base, it's massive, right? So yes, so 10% steady state kind of a top line and EBITDA of around 15%. Just want to be very, very clear that these are the numbers, and it's kind of it's not just home textiles alone, right? It's everything that comes to play here. So yeah, that's what we are talking about. We are talking about a net debt, and net debt we have committed to be around closer to around 1,000 crores, and we're going to maintain that as well. And that's where we see, and we will continue. And so any other investments that we'll do, we'll look at with prudence as well in the terms of our ROCE, and which is now at 14.6 and will be, will get better as we go towards the end of the year as well.
And the last recorded number of the net debt was 1,500-1,600 crores, which came down from around 1,800 crores. So in the second half of the year, it comes down by 500-600 crores. Are we getting that correct?
Yes, absolutely, Nigel. Closer there, yeah.
Okay, got that. I want to understand a little more about pricing, right? How are we looking at pricing, both in terms of the flooring space as well as in, the bed and bath linen? Is there scope to increase prices now that, of course, consumption is also picking up, demand, premiumization has come back in a big way? Can you increase prices further across the board?
It's about the basket. It's a product basket, Sonia, that you talk about, right? And when I talk about United States or globally, I think it has to be very, very competitive. And I think that's where it's a very, very volume kind of a game and volume kind of a perception. I mean, the consumer is, believe me, in the past 20 years and the 30 years, the prices have remained constant. Only the offshoring happened, right? So I think as suppliers to these kind of countries, we got to be looking at our competitiveness, coming closer. And I think I'll also give you a perspective here. our share of shelf has improved. So when I talk about a share of shelf, it's not just the private label that we sell here. You know, the Q2 sold 67% of our innovative products for exports. Then we have our, licensed brands like Martha as well. That actually, and these kind of global brands like we have Martha, or like a Creative Collab, Christie, which is our own brand. They actually contributed to a growth to around 17%. So I think it's also the product mix that you're talking about. It's not just a towel and a sheet that we sell here. We have rugs, we have bath rugs, we have carpets, flooring, and also additional portfolios that come in with our licensed brands like flannel, fashion bedding. So that actually increases that kind of your product basket and a product mix, and hence your enhances your product mix as well, right? And India, of course, Spaces is doing very well, which is a premium brand, and our Wellspun, which goes Har Ghar Wellspun. We are around 15,000 MBOs that we're present in, growing to 50,000 stores by end of 2026. So yes, that's where we are, and we're good to go.
Well, I mean, looks good. It's a pretty comprehensive portfolio in that sense. Just to touch upon something you mentioned right at the beginning, and this is slightly near term, which is these shipping disruptions. I mean, they're not yet to become very large, but everyone is talking about this. Can you tell us, what is shipping as a percentage of your total sort of cost? And in 2021, we had, container rates, etc., had shot through the roof. At that point, did you get hit in a quarter or two? I mean, what can we expect?
That year was absolutely a chaotic year, Prashant. And all the three C's, container, cotton, and the whole coal, the energy basket went for a toss for us. And when I talk about our, the whole containers and the whole ship, that actually contributes around 5 to 7% of a total, kind of cost that we're talking about, because we actually till today we ship around 90% of our goods across, right? Across the globe. So yeah, that's where it is. But having said that, I think the interesting thing is that, these which actually change our whole destiny, we are completely in control. So we really are managing everything. And I think for all of us at corporates, at level, I think it's not just about reactive analytics. And now we are going towards predictive analytics as well, Prashant. So I think for us as organizations, being more proactive, an ability to see and preempt what it could be is a very, very important, it's a necessity. It determines your fate. And I think that's going to be the way forward as well. So I think for all of us, I think the predictive analytics, the way we are going to be looking at ourselves, is going to be really the norm as well.
Oh.
All right, Dipali, we'll leave it there. Thank you very much for joining us, and we wish you all the best of luck as we wrap up this year and, of course, get into 2024. Speak to you soon again. Thanks very much.
Thank you. Bye.
All right, that's Wellspun Living, one of the big winners of 2023, and looking good. The market, by the way, is down about, 46 points. We're at 21,370 at this point in time. Let's move on and talk about markets. It's a special segment, Charting Trends, and we have Sachidanand D. Utekar, Associate Vice President, Technical Equity at Trade Bulls, who's with us. Sachidanand, great to have you with us here. Good morning. Are we at a bit of a critical juncture, or this is one of those pauses which, will last 2 or 3 days, and then the move, sort of upward move begins again? Apart from sort of classical indicators like RSI, etc., which of course are screaming overbought, there are no real, big. The price itself is not telling you, it's not broken anything to tell you that there's a big move down coming, even short-lived one. What's your sense?
Good morning, Prashant. As you rightly pointed out, markets are looking a bit overbought when we look at the daily structure. In fact, yesterday itself, we saw a doji kind of formation on the Nifty. It was an inside bar, and plus the call writing at around 21,000 was significant. And that's why I think, the market is taking its time to surpass that particular level. But on the lower side, I think at least for this particular series, the floor is well set at around 21,000. 21,070 would be a dependable stop loss zone below which probably we may see the trend structure, getting, changed. But as of now, I think there are no major signs of any major distortion. Probably after a very strong run-up of almost 12 to 10% without any major time and price correction, that's why I think there is some fatigue which may come in. But overall structure is looking very healthy. In fact, if you remember on this particular show itself, at around 19,800, we had indicated one particular setup on the ADX, on the monthly ADX, which actually gave us the confidence that Nifty could stretch its legs towards 21,400. So that particular level has been achieved today. The level has been achieved way too early. In fact, we were anticipating that this particular move may unfold in the end of December, January kind of a legs. But I think the structure itself is looking healthy. The flow has been very consistent. All we need is a meaningful correction, time and price wise, and that's why I think the trajectory on the higher side, still looks progressing. On the upside, we are anticipating that eventually Nifty could scale towards 22,240, probably in few months itself. And if you look at a trading momentum play, then I think a pullback towards 21,210, 240 is necessary. So as of now, I think it's a good, healthy trend. All we need a consolidation or a correction. The support is well established at 21,000. The base is very strong there. So unless we don't slip below that particular base, there may not be any major change in the structure.
All right. On individual stocks, what are you looking at? Sachidanand, good morning. Where do you see more traction on the upside?
Well, if you look at the sector plays, clearly IT is something wherein we are, seeing a good progressing trend here. Nifty IT on the relative strength basis has actually moved, surpassed its April 2022 and December 2021 highs. On the price, there's a fair amount of upside which is yet to be seen. And we are anticipating that eventually Nifty IT itself can move towards 36,600, 39,000 kind of levels, and it could surpass those all-time high levels as well. So I think a decline during this particular phase of the market is necessary, and we are comfortable, building long positions here. Coforge is one particular stock that we have recommended to our clients. If you look at the overall structure, the stock has breached above its life high zone. And if you look at the overall structure, it looks like a classic rounding bottom formation on the monthly scale. Now, this particular breakout has happened significantly with volumes and price action, and that's why we are expecting that going forward. From a portfolio perspective, the stock can be accumulated with a stop loss at around 55.80. Eventually, we see this stock scaling towards 76.60, followed by 8400. The other stock on our radar from a trading momentum basis from the same space is Wipro. Even here, if you look at the structure, recently the stock managed to give us a rounding bottom breakout at around 445, 440 levels. There's a good strong pullback which is necessary. This particular pullback which is evolving right now can get arrested up to around 435. So on a decline, the stock can be accumulated for a price target of around 490. Keeping a stop loss somewhere close to around 428.
Okay. Sachidanand, great to have you with us here. Good conversation as always, and we'll watch out for some of these stocks and, of course, your overall view on the index as well. The market is down about 35, 36 odd points, so there's not very much going on. Z, let's just do a quick check once again, is down about 4%, 4.5%, 268 on Z. So that has got some pressure going. Yes Bank is down about 2%, if you can have these up. Yes Bank has got huge volumes for now. Nalco is down about 2.5%. Stocks down about 2.5%. Bandhan Bank is another one which is down about 2.5%. That's a large one, which is showing up. All these got large volumes. LT Foods is another one, 3.6 lower on LT Foods. Again, only reason I'm mentioning this is because of the volumes here. And I mentioned Max Healthcare started about 1.5 lower, is down about 2.5% right now. KFin Technologies, right? I mean, the capital market intermediary, that is down about just under 500 rupees at about 496. You got HBL Power, KPI Green, there is Aether Industries, there is Radico, there's a fair bit happening on the downside as well. Market breadth, even with 20 minutes ago, which was 3:1, is now completely flattened out. It's almost 1:1. Almost 1,100 stocks are higher, and about 1,050 stocks are actually lower, and almost coming to a 1:1 kind of ratio. We'll take a quick break here. We are back. We put the focus on commodities. Manisha is going to be here with that just a bit.
CNBC-TV18, embarking on a quarter century of excellence. Muthoot Microfinance. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Let's get straight down to the commodity markets now. Manisha Gupta is joining in to give us a quick update on that. Manisha, what's the one commodity you're tracking today?
I'm looking at the crude oil prices, Sonia, because there's just so much of news flow into this one in sense of supplies, geopolitics, etc. So while we did see a 3% of a knee-jerk reaction on the higher side in case of crude oil prices, those levels haven't held on, and we've seen a bit of a profit-taking coming in right now. But this is a developing story as the U.S. announces 10-nation Red Sea coalition against those Houthi attacks. And this is after we have seen Houthi attacks via missiles and drones on commercial tankers. This is in the Red Sea, or the Suez Canal as we call it. Well, there is support also from the fact that these are bigger names that you are seeing which are halting now operations within the Red Sea. You have in the oil companies BP, Equinor, Euronav. They are avoiding Suez Canal and they will go via a longer route, which is Cape of Good Hope. When it comes to the shipping companies, you have the biggest in the world, which is MSC, and then big giants like Hapag-Lloyd and Maersk also pausing travel through the Red Sea. This is what is adding to premium within the free trades, and also in case of the crude oil prices and various other grains, etc., which actually have had tankers there stuck at this point in time. Suez Canal, remember, is the key shipping route. It also is the shortest when it comes to trade between Europe and Asia, and that is what is bothering. Also, when you look at the overall shipping trade transactions within the world, 15% of that happens via Suez Canal, is the reason the markets are keeping a keen eye on to this one right now. Well, apart from that, there are various other statements coming in as well. One coming in from Iran, which says that the Israel-led cyber attack has led to disruption at petrol stations across country. So this is something that's not going to die soon. Other statement comes in from US, which also is pushing the shipping companies to disclose more information on their Russian dealings, whether or not it's at a discounted crude. So there is more restrictions and stringent rules also coming in there. Apart from that, you have Russia, which has now announced that apart from the agreed deal, 50,000 barrels per day of additional export cut is what they are looking at in for December. There also are maintenance, and there has been storms in Russia, so that has added some premium to the Ural prices there as well. And then it is also about the crude Jan, which is cheaper than the Feb. That tells you that the contango is in place. So there is no immediate physical demand that you are seeing in case of crude. Markets also are dealing with record production continuing in case of US. So it really is about balancing within the geopolitical tensions and the kind of production that we've seen come in from US. This is what we've done in sense of prices. Last 1 week has seen a strong run-up, so 5.5% of a jump up in case of prices. But when it comes to last 1 month, it's 6% down. In this year also, we are into negative by 4.5% when it comes to crude prices.
All right, Manisha, thank you very much for that. So that is commodities in focus. Apollo Tyres is the one that we're focusing on right now. Sudarshan is here with details. Sudarshan.
The stock of Apollo Tyres is up more than 3% after company saw a change of hands of 4.5% equity in today's block deal window. If we calculate the size of the block deal as per floor price of rupees 440 per share, the size is coming at more than rupees 1200 crore. After today's block deal, the holding of White Iris Investment, which is an affiliate of Warburg Pincus, will reduce to less than 4%, and there will be 90-day lock-in period if it wants to sell further stake. In 2023 so far, Apollo Tyres has given returns of 40%, and that is in line with the returns given by other tyre stocks.
All right, thanks a lot for that. So that's an Apollo Tyres fresh high this morning. But Devyani International is the one that's making waves with their foray into the Thailand market. Mangalam is here to get you all hungry about this discussion on Devyani International and what it's providing to the Thailand market. Mangalam, over to you.
Well, what's better than a burger or, on a holiday or in December? Well, it's if you have that burger in Thailand. 274 KFC restaurants that Devyani International has gone ahead and acquired through a partnership. In this partnership, they will own around 51% stake. Of course, Temasek will be owning the other 49%, for which Devyani will be paying 340 crores as its share. The overall deal is a little over 1,050 odd crore rupees itself. Now, Restaurant Development Company, the company that they've acquired, their FY23 revenue was close to 1,180 crores. So this adding to Devyani's overall book would mean about 35 to 40% addition in their consolidated revenues and EBITDA, but that's on a line-by-line basis. But if you remove the minority interest part of it, the overall addition to their business will be 14 to 19%, and that's why the stock is higher. The other reason why the stock is higher is because this acquisition, which is around 1 times sales and 8 times EV to EBITDA, is at a big discount to their own valuations of 7 times sales and 50 times EV to EBITDA itself. And as a result of which the street is viewing this as a big positive. However, some concerns is that, brokers like Jefferies, they're saying that we would have liked the India growth effort instead of this going into another overseas market. And they hope that this does not kick off overseas M&A. We've seen this in the QSR space with Jubilant Foodworks acquiring a couple of companies, and as did Restaurant Brands Asia, which operates Burger King in India.
All right, Mangalam, thank you very much for that. Look at the market now, 75 points lower, and there is a bit of a correction which seems to be setting in. Looks, so far the script is almost like yesterday. The market saw a first dip within the first hour, but then that got completely, that disappeared. I mean, the market went into the green, and then later in the second half, there was the second dip which came through. The high, by the way, is made at 936 this morning at about 21,440. We're at 21,344 now, so about 100 points off the day's high. We'll take a break here. On the other side, our special segment is the economy. My colleague Lata will get chatting with Samir and Chakrabarti of Citi, and they decode if there is a dovish pivot from the RBI as well after what the Fed said last Wednesday, and they'll decode in Citi India's outlook for 2024. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
Co-powered by